Welcome back to Iron Financial. Listen, if you really want to forge a stronger portfolio, you have to be willing to walk right into the heat. You've got to strip away the daily noise, tune out the talking heads, and look at the raw, unbending steel of the market. Today, we are hammering out the exact details of John Deere's Q2 2026 earnings report in this explainer. I am your lead analyst, and as always, we are here to help you cut through the market weakness, test the structural integrity of your investments, and ultimately build real wealth. And I'm going to tell you right off the bat, Deere is presenting us with what might just be the absolute most fascinating divergence trade of the entire fiscal year. We are talking about a massive, deeply established industrial heavyweight that is currently tearing itself in two completely different directions simultaneously. And I'm your market skeptic, because let's face it, out there in the broader market, everyone is just selling a story. My job today is to ask the hard questions. Is this hype, or is it real? Are we looking at a genuinely solid foundation here, or are we about to step blindly into a massive value trap? A divergence trade sounds great on paper, for sure, but I need to see the actual proof. Exactly. No fluff. Let's fire up the forge and get right into it.
So here is the core paradox that we absolutely need to unpack today. Deere delivered an earnings report that on its face didn't hide the ball at all. They posted a massive double beat. They effortlessly cleared the bar on revenue, and they cleared the bar on earnings. Yet the stock just bled out, dropping nearly 5% right after the report dropped.
Right, and that's exactly what has everyone out there scratching their heads right now. Normally you see a double beat, you expect a nice rally, but the market just dumped it. Light volume, sure, but a 5% haircut is still a 5% haircut. So what exactly did the algorithms and the institutional money see under the hood that spooked them so badly?
Well, they saw what was actually holding the house up. To really understand this bleed, we have to drill down into the absolute raw numbers and look at the two very distinct halves of this industrial giant.
Let's start with the headline victory. Deere absolutely crushed Wall Street's expectations with a massive 15% beat on adjusted earnings per share. 15%! Let's put that into context for a second. In this current macroeconomic environment, with elevated interest rates, persistent inflation, and tightening credit markets across the board, pulling off a 15% EPS beat is incredibly rare. It is a serious, undeniable display of operational leverage and strict cost control. I mean, most industrial giants are just trying to hit par right now, not overshoot by double digits. Okay, I hear you, but hold on a second. Is that 15% beat actually built on a solid, structural foundation, or is this just a temporary sugar high? Because if earnings are beating but the stock is bleeding, that immediately tells me the street thinks the earnings quality is masking some deeper structural cracks. Are they just aggressively squeezing blood from a stone before the economic cycle completely turns on them? That is the exact right question to ask. The top-line number looks fantastic, but the underlying mechanisms are grinding against each other, and the answer requires us to stop looking at Deere as just one monolithic company.
We are officially starting our drill-down phase. When you look at the machinery lineup on screen, you'll see it covers incredibly diverse end markets. You've got the traditional iconic green tractors on one side and the massive yellow earth movers on the other. To understand why the stock sold off despite the earnings beat, we literally have to split Deere into its two distinct halves, the agricultural drag and the construction heavy lifting.
Right, and the agricultural side has always been Deere's golden goose. But reading between the lines of this latest report, that goose is looking severely tarnished. Tarnished is putting it mildly.
Let's look at the actual numbers.
Part 1 of our breakdown, cracks in the armor. The ag business bleeds.
When we really drill into the production and precision agriculture business, the bleeding is severe. Overall net sales for the entire division dropped a staggering 14% in the quarter. Furthermore, they guided to a full-year loss between 5 and 10% for the ag segment. This isn't just a one-quarter blip, folks. When you dig into the regional data, the localized damage in their most historically profitable markets becomes glaringly obvious. Just look at the North American numbers. US and Canada, large ag volumes plunged an estimated 15 to 20%.
A 15 to 20% plunge. That's absolutely brutal. Why are farmers pulling back so hard, so fast?
It's the macro environment acting as an absolute vice grip on their operations. Farmers are facing an onslaught of inflation. And it's not just diesel fuel filling up the tank. It's the surging cost of specialized fertilizer, it's genetically modified seeds, and of course, it's the aggressively elevated financing costs of the heavy equipment itself. Add to that the severe geopolitical risks, specifically conflicts, bringing essential maritime traffic in the Strait of Hormuz and the Red Sea to a virtual standstill, and you have a global supply chain that is just choking the farmers' margins. When cash crop farmers feel that intense squeeze on their balance sheets, the absolute first thing they delay is a brand new $500,000 combine purchase.
But remember, Deere isn't just a North American company. 40% of their revenue is generated overseas. Let's break down the global geographic mix. Europe is actually showing slight resilience, coming in flat to up 5%. But the truly crucial buffer here is South America, specifically Latin America, which accounts for over $5.5 billion in annual sales. This market is acting as a critical weld right now, offsetting US dollar softness. Okay, $5.5 billion in South America is a great buffer, sure. And we also saw the White House estimating that China will buy an additional $17 billion in American farm goods annually, which extends way beyond just soybeans. But is that $17 billion US-China agreement actually enough to stop the bleeding overseas?
Because when I look at the data for Asia, I see a 5% contraction. That tells me the international softness is very, very real. I have to challenge you here, is this global agricultural winter simply too deep for Deere to survive without taking severe margin hits across the board? I mean, a flat South America and a contracting Asia don't exactly scream growth.
You know what? You are absolutely right to push back on that. I'm not going to sugarcoat it. A 5% contraction in Asia is a real, tangible dent in their global armor. The ag sector is undoubtedly taken on water, and the headwinds are incredibly stiff. But here is where we separate the retail investors from the institutional analysts. Deere is not entirely dependent on the harvest anymore. They have a massive structural counterweight built right into their business model.
This text comparison brilliantly illustrates the massive divergence happening within the company. On one side, production and precision ag is down 14% in net sales, staring down that 5 to 10% full-year loss. But look at the other side. Construction and forestry is actually forecasting a 20% net sales growth.
Wow. So the solid foundation of construction is desperately trying to offset the deep cracks in the ag business. It's a complete tug of war.
Exactly. And construction is pulling extremely hard. Let's shift our focus to the heavy lifting.
Which brings us to part 2, doing the heavy lifting. Construction builds the base.
As we just saw, construction and forestry is the undeniable bright spot here, with that forecasted 20% growth in net sales. This is an extraordinary number. But let's actually dissect the end market strength in North America. US and Canada construction equipment is climbing, coming in flat to up 5% in actual retail volumes.
Wait, pause right there. If retail end markets, the actual volume of machines physically moving off the lot, are only up 5%, how on earth are they guiding for 20% net sales growth? Is this demand real, sustainable end market growth, or is this just a temporary post-pandemic inventory rebuild? Are they just stuffing the channel with excess yellow iron to make the quarter look good?
That is the exact level of scrutiny we need to apply. But listen, it's not channel stuffing. It's a combination of aggressive pricing power, favorable currency tailwinds, and incredibly strategic production planning from last year. And the demand is absolutely real. It aligns perfectly with the explosive structural builds we're seeing across the tech and industrial sectors. Let me definitively answer your skepticism with a quote straight from the earnings call.
Lead analyst Josh Beal, the director of investor relations, came right out and stated that resilience is, quote, bolstered by U.S. government infrastructure investments, decreasing interest rates, and improved rental demand.
Okay, well, government infrastructure is a historically reliable catalyst.
It absolutely is. The Infrastructure Investment and Jobs Act is finally putting real shovels in the ground. Furthermore, contractor confidence is sky high. When you look at the macro data, contractors are sitting on expanding backlogs that are lasting all the way into 2027. We are talking about massive data center megaprojects, the reshoring of domestic semiconductor manufacturing facilities, and heavy highway builds. They literally need to invest heavily in their fleets to meet these long-term contracts. Plus, Deere purposely underproduced retail in the first half of fiscal 2025. They strategically held back production. That highly disciplined approach set them up to produce directly in line with retail demand this year, creating a robust baseline for 2026 without flooding the market.
Part 3, forging the margins. Will the steel actually hold?
All right, I'll concede that the construction top line looks solid and those backlogs are definitely real. But let's pivot the debate to profitability for a second, because revenue is vanity and margin is sanity. How can Deere possibly maintain its steel-clad margins when its most historically profitable sector, agriculture, is taking on so much water? Are we going to see total margin compression across the entire enterprise?
That is the multi-billion-dollar question. Let's look at the actual margin shift in real time. The margin compression in ag is undeniable. Operating margins there have bled down from an impressive 15.4% to the 11 to 13% range. But look at how construction is acting as the structural support here. construction and forestry margins are actually moving up, climbing from 9% to the 10 to 12% range.
So construction isn't just bringing in top-line revenue volume, it's actively becoming more profitable to bridge the gap.
Exactly. But there's another crucial factor keeping the entire structure from collapsing, and it really comes down to sheer pricing power.
1.5%. That is the exact pricing power Deere is fiercely defending in large ag for the full year. Despite a massive 15 to 20% volume plunge in unit sales, they are not drastically slashing prices just to move metal off the lot. Wow, that's a bold move, holding your price when volume is actively crashing all around you. It's the critical weld holding the long-term value of this company together. This unwavering pricing strategy is absolutely essential. Think about it. If you start slashing prices on a $500,000 combine today, you immediately destroy the residual value of the entire existing fleet, which infuriates your loyal customer base and permanently damages your brand equity. By holding the line, they ensure that when the agricultural cycle eventually turns back upwards, and it always does, they haven't destroyed their historic margin baseline. And there is a fundamental data point showing that this highly disciplined strategy might just work.
When we look at the internal metrics, we see that in North America, large ag used inventory destocking actually accelerated by 4% over the quarter. Market Skeptic, I want to stop you right there, because the audience needs to understand exactly why a 4% destock matters. Like, does this actually unfreeze the trade ladder you've been talking about? Yes, it is incredibly important. Listen, for those unfamiliar, the trade ladder is the fundamental mechanism of how farmers upgrade their equipment. They almost always trade in their used equipment to a dealer to offset the massive cost of buying new. If those dealer lots are completely choked with excess used inventory, the dealers drop their trade-in values. The trade-in values plummet, and farmers simply choose to hold on to their old machines. By aggressively flushing out that used inventory by 4%, used prices stabilize. It clears the lot, it completely opens up the trade ladder, and it sparks organic replacement demand for new machines, even in a tough macro environment.
Moving on to Part 4, the valuation blueprint. Is this just a value trap?
So we've deeply analyzed the operations, and we've stress-tested the margins. Now we move into the final major analytical phase, the valuation blueprint. We need to objectively determine if this post-earnings 5% dip is a crack in the foundation that you should run from, or a buying opportunity to add premium steel to your portfolio. Market Skeptic. Let's see the multiples. Because if I'm buying into an agricultural winter, I want a massive discount. Well, look at the numbers. Deere is currently trading at a 30 times price-to-earnings ratio. Now that has cooled off slightly from the 32 times PE it was commanding recently, and we are seeing similar modest cooldowns in price-to-sales and price-to-book ratios. 30 times earnings? Are you kidding me? For an industrial heavy equipment manufacturer, that is a massive, towering premium compared to the broader S&P 500. Historically, companies that build tractors and earth movers trade closer to 15 or maybe 18 times earnings. Does a company that builds heavy yellow iron really deserve a tech-level multiple, especially when their core ag business is declining by double digits? It smells exactly like an overvalued trap. It would absolutely be a value trap if they were just building dumb iron. But they aren't. They are actively transforming into a technology company that just happens to be wrapped in green steel.
Deere has executed a massive structural pivot into artificial intelligence and high-level global connectivity. This completely changes the valuation paradigm from a cyclical industrial stock to a recurring revenue tech play. And if you dig into the recent S1 filings from SpaceX, you discover something absolutely incredible that proves this point. John Deere is explicitly named as a top-tier Starlink customer.
That's genuinely fascinating. So they are integrating low Earth orbit satellite connectivity directly into the fleet, regardless of how remote the farm is.
Exactly. They are fundamentally part of the larger global connectivity story now. They aren't just selling a tractor. They are building autonomous, AI-driven precision machines that communicate in real time. That massive data ecosystem, the software subscriptions, and the incredible efficiency gains for the end user are exactly what justifies a 30 times premium valuation. The market is looking entirely past the current hardware cycle and pricing in the software future.
And the street overwhelmingly agrees with this long-term thesis. Heading into earnings, the consensus price target from major analysts was a massive $655.45. With the recent post-earnings dip, which, by the way, occurred on lighter-than-average volume, strongly suggesting seller exhaustion and signaling that the stock is rapidly approaching oversold territory, that target implies a potential upside of over 20% from current levels.
And while you wait for that 20% upside to materialize, you get a 1.2% dividend yield. It's certainly not going to make you rich overnight, but it is a highly secure, well-capitalized shock absorber for your portfolio while you wait for the company's agricultural fortunes to reverse.
Finally, it's time for the iron verdict. Is it an opportunity or a trap?
All right, we've broken down the raw financials, we've stress-tested the margins, and we've weighed the valuation blueprint. It is time to quench the steel and deliver the final, hard-hitting verdict for the iron financial audience. Here is your iron verdict. Number 1. The ag bleed is absolutely real. A 15 to 20% drop in North American large ag is a severe structural headwind that you simply cannot afford to ignore. Number 2. The steel foundation is holding strong. 20% construction growth, fueled by megaprojects and massive infrastructure spending, is doing the heavy lifting, supported by brilliant capacity management from last year. Number 3. The valuation blueprint. A 30 times PE is undeniably rich, but we strongly believe the premium is justified by their structural pivot away from dumb iron and into AI and Starlink connectivity. So what is the call? With the stock approaching oversold territory on light volume, we view this post-earnings dip as a solid opportunity to acquire a premium, market-leading asset, provided your portfolio can actually stomach the short-term agricultural winter.
Market Skeptic, and really, that's the ultimate test of strength, isn't it? As you review your own portfolio today, you have to ask yourself, do you trust the steel? Will Deere's construction foundation outlast its agricultural winter, or will the sheer weight pull it down? Let us know what you think. Are you buying the dip or waiting for clearer skies? Thanks for joining us in the Forge today. Keep your numbers tight, cut through the noise, and keep your portfolio resilient. We'll see you next time on Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.